Hello, chart watchers, and welcome to this Tuesday, July 3rd Market Watchers live show with your hosts, Tom Bowley and Erin Swinlin. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. Well, market trying to continue the recovery efforts for the past couple of days. We got the Dow Jones currently up 30 points, the S&P 500 up 4. The NASDAQ, however, a little bit underperforming on a relative basis, down 13 points, while the Russell 2000 outperforms on a relative basis, up about 8.5 points. 10-year Treasury yield got off to a pretty good start this morning, was up earlier, but it is now down 3 basis points, back to 2.84%. Volatility index continuing to drop, had a big reversal yesterday, was up over 18 earlier in the day yesterday, now back down below 15 at 14.96. Energy continuing to try to move higher. Crude oil was surging earlier this morning, had moved above $75 a barrel, but it has reversed. And as you can see, the XLE also reversing off of earlier highs, but still leading the market to the upside. Financials moved up earlier, but pulling back in key areas like banks continue to struggle. You can see the failures. Each time we get up close to this 20-day moving average, the banks roll back over. We do have really good longer term, or at least intermediate term support on the bank index between 450 and 455. We're currently at 456. Technology also started off pretty good earlier in the session, but has reversed and is now down about 1/3, 1%. Internet stocks hurting the XLK, but certainly helping their underperformance as Facebook comes under some additional scrutiny, according to the Washington Post. We'll talk about that in a few minutes. But it is the day before July 4th, Erin. I don't know if you have anything planned for July 4th. I heard you could probably go outside and roast some marshmallows this weekend.
Yes, absolutely. Thankfully, the weather will be all right for the 4th of July and for tonight. But yeah, Friday, Saturday, and Sunday. Friday and Saturday, our high is supposed to be 109. And then we cool off on Sunday down to 100. So it's going to be a rough weekend as far as that. A lot of air conditioning being run. But yeah, tonight we're actually going to have the neighbors get together. And tomorrow there's a family thing that we're going to have that we're going to be going to. So should be a lot of fun for this Independence Day.
Yeah, tomorrow I think we're going to head out onto the lake, and the weather in Charlotte. I mean, once you move into latter part of June and into July, I mean, really the next 2 months, I could probably give you the weather forecast. It's going to be a high of about 95, chance of thunderstorms in the afternoon, cooling off to about 78 at night.
Mm-hmm.
That is about it. Very humid. Tends to be very humid.
Oh, here. That's true. At least, as they say, we have a dry heat.
Yeah, 109. I don't care how dry it is. It's hot.
Exactly. You certainly don't notice the difference as far as being uncomfortable. So yes, tomorrow, Independence Day, we are not going to have any, we won't have Market Watchers live. Thursday, Bruce Frazier will join us. He will talk to us about Wyckoff. And then you have a workshop on Tuesday of next week. And I'm sure you do not have a title yet. So
you are correct.
Yes. And Tushar Shande is going to be here on next Wednesday. So it should be a great rest of the week. And I'm looking forward to next week as well. Today's agenda, I'm going to be doing a workshop today on trading chart patterns. I think you'll find that interesting. 10 and 10, we're going to do booking holdings as our first symbol. And then finally, Tom's going to finish it up with a scooter report. So lots to talk about. And as you said, I know that Facebook's in the news. Any other news you wanted to talk about, Tom?
Well, we'll start off with the usual suspect. The 10-year Treasury yield did have one economic report out this morning, and that was May factory orders. Came in better than expected. They rose 0.4%. Market was just expecting a flat report, so a little bit better than expected there, and that came out at 10 a.m. this morning. You've got the 10-year Treasury yield, though. Here was the move up. We had gapped up earlier near that 20-day moving average, and now we've pulled back down. So, again, we continue to trade beneath the 20-day, and at least from a short-term perspective, I think I mentioned this last couple of days, but from a short-term perspective, I'd like to see the yield get back up above that 20-day moving average. And there may be some of you who think, well, you know, why would we want higher interest rates? But anytime the yield's moving higher, it means the money is rotating away from treasuries, and that money tends to find its way into equities. So there is a pretty strong positive correlation between the direction of treasury yields in the short term with the S&P 500. Of course, the long term, if you go back and look at the 10-year Treasury yield, 30, 40 years ago, we were much higher, and now we're down at the 2.83, 2.84% level. And you might say, well, how can there be a positive correlation? The 10-year Treasury yield's been going down for 30 years. The S&P 500 has been going up for 30 or 40 years. It's not a positive correlation in the long term. One of the things that drives both the yield and equity prices, well, at least the equity prices higher and Treasury prices higher over long periods of time, is that there's constantly new money coming into the markets, both markets. It's really the short term that you want to focus on, short to intermediate term. When the 10-year Treasury yield goes on a move to the upside, not only are we seeing new money coming into the stock market, but we also see money rotating from the Treasury market. That's what drives those yields higher. Money rotates out of the Treasury and moves into the stock market. So we have seen some pretty explosive moves to the upside in the equity market when the 10-year Treasury yield, begins to move to the upside. So that's why we want to kind of watch that. That's why I want to see the 10-year Treasury yield back up above that 20-day moving average, at least begin to show some technical signs that perhaps we're going to make another run for that 3.11% area. So I do want to mention, though, Erin mentioned at the beginning that Market Watchers Live will not be here tomorrow. The stock market is closed. Later today, actually, the stock market closes early. So we are closing in the U.S. at 1 p.m. So less than an hour from now, we'll be closing. So I think this will be the first Market Watchers Live where we actually are broadcasting when the stock market is closed. We'll be doing that in about an hour or so. Also, the bond market closes early today. I believe it's 2 p.m. Eastern, an hour after the stock market closes. The bond market will be closing as well. Okay, a couple of things I wanted to point out today. One, the Russell 2000 versus the S&P 500. I continue to believe in the small caps because I do think that the dollar is going to go higher and break out. I'm looking for the dollar USD or the dollar index to break out above 95. I do think in the short term we could consolidate. And if you look at this chart on the Russell 2000 relative to the S&P 500, we did test a relative price high from back at the end of 2016 before the dollar started to fall. And as the dollar fell, more and more money rotated toward the S&P 500. Those multinational companies, large cap multinationals that are found on the S&P 500 tend to do better when the dollar is declining because all their profits they make in foreign countries get converted back, and they actually have foreign currency translation gains when the dollar is declining. Unfortunately, the opposite occurs for S&P 500 companies when the dollar's on the rise. And that's what we've been seeing since we had a double bottom on the dollar back in February. And you can see since then with the dollar on the rise, small caps are outperforming. I think this is going to continue because I expect the dollar to continue to outperform. Small caps versus the S&P is one consideration when you're looking at what's going on with the dollar. But another big one is how commodities perform. So this first chart I wanted to show you is the dollar index on the top from 2003 through 2007. So as the dollar was declining, you can see that the CRB index, which is a commodity index, was on the rise. And on a relative basis, throughout much of the bull market, you can see that the CRB outperformed the S&P. It wasn't a huge outperformance, but you can kind of see that we were rising until energy prices started to get hit in 2006. And then that kind of fell apart. But that was how the 2003, 2007 bull market moved based on the dollar and what happened to commodities. Now I want you to look at what's been happening since the dollar bottomed in 2011. That's where we put in the major bottom. And I believe if you connect the lows coming across here, we literally turned right on this trend line, started to move higher. And if we break above 95, I'm looking for a push all the way back up near the 102, 103, 104 high that we saw late 2016. So if that continues, if the dollar continues moving up, look at what the CRB index has been doing since the dollar bottomed back in 2011. The CRB index continues to move lower. Yes, we're in a slight move to the upside, but if you look at, if you're trying to outperform the S&P 500, it's really hard to do it with commodities, especially in an environment with the dollar on the rise. So as we continue to move lower here on a relative basis on commodities, I would continue to be really careful with the group because I do think the dollar is going to move higher. If I'm wrong, and the dollar tops out here at 95 and rolls back over to the downside, then I think commodities have a chance to outperform. But if I'm right, I believe that we will see commodities continuing to lag quite a bit. And I've talked about this before, but I'll bring it up again just as a reminder, refresher to those of you who maybe have seen this before. But if you look at what's going on in terms of the Treasury market here in the U.S. relative to Germany, and I use Germany because I think that the correlation between our markets in the U.S. and the German market, I think these are the two most positively correlated. So if I'm interested in seeing what's going to happen in the U.S., I like to follow what's going on also in Germany. So here you can see that the 10-year Treasury yield in the U.S. is moving up faster than the Treasury yield in Germany. That's what this line is telling us. The difference, the spread between the two countries' 10-year Treasury yields is continuing to move higher. So what does that mean? Well, it means that investors are betting that the U.S. economy is stronger than Germany and will continue to strengthen faster than Germany. And that tends to make the dollar move in that same direction. So over the last 10 years, you can see that as this yield has been moving higher, the spread between the two countries has been moving higher. The dollar index, for the most part, has followed suit. But I did highlight these three shaded areas in red where we saw a divergence. 10-year Treasury yield in the U.S. moving up. Here it's moving up. Here it's moving up. All three instances faster than Germany, but the dollar, for whatever reason, was moving lower. And at the end of each one of these, at least the last two, we saw the dollar surge back to the upside to start to play catch up with what was going on in the bond markets. Here you can see the dollar making a huge surge coming off of this negative divergence. And I believe we're just starting this move to the upside on this surge. Another way to look at it is by pulling up and using that correlation indicator. And you can see that when this divergence hits, look at what happens to the correlation between the difference in the Treasury yields and the dollar. Remember, they tend to go up, and you can see, or tend to move together. And that's what this positive correlation, that's why we're above zero most of the time in this correlation. But when we've actually seen some rather significant negative correlation in each of the prior two instances, we've seen the dollar rally. And when the dollar rallies, small caps rally on a relative basis versus the S&P. And that's what we're seeing now. So if we get this breakout in the dollar above 95, I expect to see that this outperformance in the Russell 2000 is going to continue. And the other impact that this dollar has really is on commodities. And if we get the breakout in the dollar, I think you have to be really careful in expecting too much from the commodity area in the market. Okay, let's pull up and take a look. Let me go back over this chart. Let's take a look at the crude oil, because yesterday crude oil surged. Well, last several days you can see crude oil prices have been surging. Finished yesterday at about $74 a barrel. Earlier this morning we were up over 75, and the last time I looked we were back down near 73. So we could be putting in some sort of a topping candle. This candle won't appear here until the close today, but it looks to me like we could be putting in a topping candle on the WTIC, which is light crude oil. And the significance is that there's a fairly strong positive correlation between the direction of crude oil prices and the direction of energy. And I was talking about this the other day, thinking that either the crude oil prices need to come back down or energy prices are likely, or energy shares are likely to make another breakout. And we may see the XLE push to another new high. At this point, the crude oil price is pulling back, but I think that's temporary. I think crude oil goes higher. I think we're going to make a run for $80 a barrel on crude oil. And I think that's going to result eventually in another breakout in the XLE and in energy in general. Okay, a few stocks on the move. Let me pull up Facebook. Talked about this briefly at the open. Facebook, the Washington Post report that came out suggested that there's an expanding federal investigation into Facebook's data sharing practices. Now, I wouldn't say that Facebook's getting hit particularly hard, but it is down 2%. That's sending the internet index down. And that in turn is having some impact on technology shares, which as the show started, technology was the worst performing sector today. Now, Facebook does have a negative divergence in play here. You can check out and see this lower PPO as we've been putting in these highs. I think we're looking for a 50-day test at a minimum, and that is down at 187. So I'm looking for a little bit more weakness here in Facebook. Also, as you saw these moves up here in these breakouts, volume was, we did have a couple of days where the volume picked up a little bit, but not exactly huge volume days. So I think that Facebook is really beginning to run out of some momentum here. We talked, I think, a few days ago about which FANG stock might struggle the most over the summer, and Facebook was my pick, mostly because of these negative divergences and just the lack of enthusiasm in the shares as we move higher. And still got this data sharing scandal out there, apparently, that potentially could be expanding. So I think there's enough negatives out there right now on Facebook where we could see the stock pull back another $5 or $6, maybe test this recent support level, the 50-day, and then we'll go from there. Tesla. His CEO Elon Musk yesterday said Tesla finally met its production target of 5,000 Model 3 vehicles in a week. They did it the last 7 days of the second quarter. And when they made the announcement yesterday, you can see the stock had gapped up from about 342 or 3 up to 360. Big gap up. Turns out it's probably more of one of these buy on the rumor, sell on the news kinds of deals. We didn't make a breakout. We had gapped up on the news. We had been trading higher for about 5 or 6 days prior to that news coming out. And then once the news broke, stock's been down $40, actually $50 from the high. So Tesla, I still think looks okay on a longer term chart. If we go out to a weekly chart, I think it's in a nice uptrend. We did have this little break here. I wouldn't want to see it back down below 300. I think this was temporary. We got back up above the 20-week moving average. I think it's okay after a pretty steep run up. We went from 280 to 370 in a month. I think pulling back down, maybe giving back half of those gains is okay in the near term, but I would expect Tesla to begin to rise again off of this pullback. AYI, this is Acuity Brands. They came out with their earnings report. They beat top line, they beat the bottom line, and so far they are trying to break this downtrend. Now, I don't like this potentially reversing candle. They have very heavy volume today, gapped up, traded up to almost 140, and now the stock's back down to 132. And where I really have my problems with a stock like Acuity is when you look at a weekly chart, stock's been coming down for a long time. This could be a false move above the 20-week moving average. If we finish this week out below 130, I'm thinking this is probably just a short-term move and maybe a move back down to retest that 110 level. Finally, another smaller software stock, ASUR, came out, and you can see the stock doesn't trade a whole lot of shares, but the stock did raise their revenue guidance from 90 million or 90.8 million up to a range of 93 to 96 million in revenue. So again, it's a smaller company, had been performing really well in May, and then in June, software stocks really got hit. This looks to me like it could be an opportunity, but I really want to see ASUR get back through the two moving averages. You can see the strength that we saw earlier today took us right up there. We tested it. We failed. We saw the same thing a week ago when we got up to the 20-day and failed. I need to see the stock back up above the 20-day before I'd be interested in taking a look at this. A couple of upgrades today. I'll go through these real quick. ROKU. I actually own ROKU, so I was happy to see the upgrade. There is some overhead resistance, though, established from a couple weeks ago near 47.5. Stock got up to 46.73 today. Still having a really strong day with the overall market just kind of flat to up a little. ROKU up 5.7%. ALB, this is Albemarle Corp. They got an upgrade. Stock's been in this long-term downtrend, trying to get through 97.50. I'm not sure. I think this upgrade is probably an opportunity for the shorts maybe to get back in. And then a couple of the airline stocks downgraded today. Delta Airlines was downgraded. Stock's been moving lower for quite some time. I've talked about the transports recently in the blog and I think on the show as well. I like the railroads. I like the truckers. Airlines have struggled. And as crude oil prices keep moving higher, that's another headwind for these airlines. So UAL also downgraded today along with AAL. And you can see all of these stocks relative to what's been going on in the market. This is a weak part of the stock market. Okay, that's what I have for today. I know Erin's got a great workshop and presentation for you on chart patterns, so take it away, Erin.
All right, let's get this started. So a lot of you probably remember when I did the introduction to chart patterns. So today I'm actually taking all of those same charts that I used to show everyone the different chart patterns, and we're going to go through them. I'll explain the pattern very quickly, and then I'll show you where I would put stops and targets and look at it that way. So we're just going to go down the line, and I will show you the various patterns. And like I said, I'll go into annotation mode and we'll start looking at support, resistance, and how we might trade or not trade a particular pattern. So we're going to start here with the ascending triangle. Here we go. Let me make this big. Okay. So this, the ascending triangle, you're going to see overhead resistance and then a rising bottoms trend line on the bottom. Ascending triangles are bullish. The expectation is a breakout to the upside because you're seeing the you're getting higher lows each time. So you can see the market and psychology, they're really getting, it's squeezing and they're ready to pop. So you see the pattern. Let's go ahead and go into annotation mode. Alrighty. And I'm going to actually trash all of these annotations so we can pretty much look at it fresh. All right. So remember, this is where we saw the pattern. Okay, there's the ascending triangle pattern. I'll go ahead and just quickly mark that, but we're going to use the skinny line. All right, this is just blurring up for me, so I'm going to do this. If it's blurry for me, I suspect it might be for you. There we go. Okay, so let's get that going, and then we have that rising bottoms trend line. Okay, so the expectation with these patterns is that you're going to get a rise about the size of the largest difference here at the end of the pattern. So that's how you would get your upside target. So this is what I would do, because the upside target, that's going to be my target. So I'm using this tool, and don't pay attention to the percentages. I really don't want to get into that, and I'm just going to show you visually how this works. So that's about the height of that pattern. So now I'm going to take it and just copy it over here. So this gives us what our upside target is. So let's go ahead and mark that with auto support resistance. All right. So obviously we don't know what's happening over here when we get to this pattern. So you want to watch it. You have it on a watch list, I would hope at this point. One of the things, of course, watching this pattern, I would be a bit concerned because you've got a declining PMO and the tops here are mostly moving across. So that's something to keep in mind. But if you're going straight off the pattern, you can see back here. In fact, I will give you a vertical. Right about here, you can see this is about the time that the PMO started to turn up. So we were already seeing some deceleration back here. If you can see that, there's just a little bit of a curve. That would have been also a sign that, okay, well, maybe we're getting this turnaround. We got the same thing here, and it turned out to be resistance, and it fell back down. But the idea, of course, is this is now my upside target, and I'm waiting for the breakout. Now, at this point, you're watching it, and you get the breakout, meaning the pattern's now confirmed. So in this case, that was a gap up. You're kind of sitting out there a little bit in the, you didn't get quite the start you maybe would have wanted there, but that's okay. But your upside target at this point is up there. You can see that at the 162.50 level. And here's, let's say you got in, somewhere in the middle here. So you've clearly got a target right up this length. And then I would set my stop probably just below this, probably make it at the top of this gap support in this case. So right now, just visually looking at it, you can see that clearly you have more upside potential than you have as far as risk. So as this plays out, you're not going to hit your stop. You're going to move sideways. And actually, you could probably see a little symmetrical triangle there, and those are continuation patterns. So you get the breakout, you hit your target. And what do we do when we hit our target? That's when you reevaluate. So let's see what's going on there with a vertical line. Okay, we hit our target back here. What's happening with the PMO? It's still rising. It's actually putting distance between itself and its signal line. So things are looking good still. So at this point, I would raise my target. I don't have anything back here to compare it to make my next target, but I'm not going to worry about that. I'm going to stay with the trade. And I would adjust my stop. Again, I like to adjust stops, not actually where folks normally would do it, because everybody's stop will trigger at that point. And you could get stopped out too early. You could get hung up in that big decline if you have a price shock like this. Those are things to consider. Now, because there's really not a way to set this target, I would go back to a weekly chart to see where my next target should be. But I can tell you, you would have taken that rise, and sadly, price shocks happen. And we would have fallen here, but that would have triggered our stop, and we would have still ended up with a pretty decent trade here. Now, the thing is with chart patterns, as you're going to see as we go through here, is they don't always work. They're not always very dependable. But one of the dependable formations is the bull flag. I find that flag formations are really helpful. They tend to fulfill, or at least start getting there. May not get to that target, but generally you're going to get some runoff with a bull flag, and you're generally going to see some drawdown on those reverse flags. So let's go ahead and we're going to go into annotation mode again. And I'm going to clear all of these. That's our flag, so we're going to remember that. Actually, I could probably just select. So you can see that I have put in the minimum upside target. Like I said, if you go back and watch the introduction to chart patterns, and I know that's on YouTube under our StockCharts.com channel, you can find out more about how we measure and all of that. I want to just go through so we can look at where you would set a stop and where you might not, might not want to, and where you might want to set your targets. All right, so there's our flag. We know that our upside target was up here, so I'm going to draw that in for us. And again, this is based on the chart pattern itself. That's what your target will come out to. So we've got our upside target. I would also be watching this level as well. So this is our minimum upside target for the flag. But like I said, they're not always dependable. In fact, you can look back here and look at that beautiful flag that formed, and then it failed. And it failed miserably. So it's not a guarantee, clearly. But in this case, I would have been watching this flag. And look at the difference between the formation of this flag and the formation of that flag. What was going on with the PMO? In the formation of this flag, the PMO is rising. What was happening during the formation of this particular flag? The PMO topped and started moving down. So that would tell you, maybe don't want to jump into that particular chart pattern, but that's why I use the PMO to do my sorting and then go from there and look for those chart patterns. So we know that's going to be our minimum upside target, but I would be thinking about the previous overhead resistance that we're seeing at that top back there earlier in March. Let's see, yes, March timeframe. So that would be one that I would be watching. I would probably, in all honesty, I would set my reevaluation target to here, because of the fact that that's where your overhead resistance is. So we get the breakout. We're very excited. We jump on in here, right? And we begin to ride this out. We start hitting that overhead resistance. So what is the best thing to do? Let's look at what's going on with the PMO as it hit that overhead resistance. It started topping. Even if you got caught, that would have been a bad, that would be bad. And like I said, that's why you can get stuck and you can get stopped out too soon, because these patterns don't always come together. So that's why watching the PMO and what it does before that time is a good idea. So you can see there was some deceleration here already on the PMO. So something to consider. So that's how I would set my targets on a bull flag. All right, so let's go to a descending wedge. Trying to look mostly at the bullish patterns for you, but these work the same way if you're going to do a short. So descending, falling wedges, descending wedge, those are considered bullish patterns, and the expectation is a breakout to the upside, and the minimum upside target is going to be the length of the back of your wedge. Not everybody uses those to create targets, but it's something that you can do. A lot of people do it that way. I think Thomas Bulkowski also calculates upside targets that same way. So let's put some of these in here. All right, so this is where we would be watching that pattern and we'd get the bump to the upside. A nice big gap up on that. So that would be the trigger of that pattern. I'd then be looking for a move about the size of the back of this pattern. And that, let's see, yeah, about here. All right, so our upside target is, not quite, well, it's not that high. And if you were buying in on that breakout right here at that 124 level, it's not too long before you get to that upside target. But you keep that in mind. I mean, that's something to keep in mind. For me, if I saw this, where might I put my stop? Well, probably at the gap support over here. So looking at this, the upside target, looking at the risk, I likely would have just not gone into this because I like a better risk to reward. And you can there's ways to calculate it. You're going to see many, many ways to calculate it at ChartCon. So I'm not going to go into the risk reward that way. For me, you can just look visually and you should have an idea. So in this case, this is a pattern based on what we're seeing on Honeywell that we wouldn't want to trade. But that's how you would set your stops, and that's how you would set your targets based on the chart pattern. And then you can start looking and see if that is a good thing or a bad thing. I would have probably, like I said, not traded it, but again, it ended up moving higher, but it kind of just consolidated sideways. It didn't turn out to be the best execution of a pattern. So keep that in mind. Every chart pattern doesn't need to be traded. Okay, let's look at the double bottom. I find these to be pretty accurate as well. A lot of these I've taken from back in time, just so that I could easily find them. Let's go ahead and go into annotation mode and look at what we would do with a double bottom formation. Okay, we're going to work off of this particular double bottom. It ended up fulfilling. We have the benefit of hindsight here, but I want to give you, again, the idea of where you might set your stops and where you might set your targets for these. So I'm going to, actually, there's so many going on here, so I'm just going to delete them all. All right, so there's our double bottom. And I'm going to set up our horizontal support and resistance lines here for the length of that pattern. And we know that our upside target for a double bottom should be about the length right here. So that is going to bring us up to, and I'm doing this visually, right about there. And that's the length of that pattern. Now, with all chart patterns, they're not actually the chart pattern until they execute. So you do need to watch them and look for the execution on them. Now, in this case, we did get a breakout, a slight one. I might have waited a little bit longer for that breakout to turn into something better. But let's see. So there's our upside target. That's a pretty long way. I wouldn't be looking at that as my complete target. Maybe on a longer term investment, sure, I can leave that up there. Now the question is, where is our stop if we want to go for a longer term hit here? I would be looking at previous lows back here as possible areas of support where you might set your stop. Okay, so when you're looking at this, okay, we've got a pretty good setup here for a target, and our risk is not quite so bad depending on where we decide to set that stop. We get the breakout and what's going on down here. We get a 20, 50-day positive crossover, so it's okay, let's keep this going. I would probably be marking here, like I said, for a reevaluation point. We would have hit that target. At that point, I could make my decision. Do I think this is going to ride out all the way to the top? Well, let's look at what's going on with the PMO. Hit that target right about here. PMO is looking great. It's putting distance between itself and its signal line. There's nothing here to tell me that I should be overly worried. So I would continue my play, but I might move my stop up now. I would probably tighten it because that's what I do when I reevaluate. I can see a level right over here. And again, I look for those support and resistance areas where we get some movement. So I would probably set my stop right about here based on the bottom over here. And you can see that was a support area when it backed off here on that pullback. I think that would be a fairly good place to set the stop. And now again, your risk to reward is still looking pretty good. You would not have ever been stopped out because you stay above that original target that you have, and you get the ride. Okay, so we hit up here at the target. That's when we start to reevaluate what's going on. Do we need to stay or should we go? All right, I would be looking at this, and what has immediately become obvious to me? Declining tops. Let's make that darker. Rising. That would clue me in that there might be some weakness that it is coming in. We had the sell signal. We did get the buy signal, but you can tell there wasn't a lot of action to accelerate and get higher. And then, like I said, it topped and we ended up with a negative divergence. So that would have been your cue to either get out or tighten that stop. And if you were going to tighten your stop, where might we look? I can see right here. That could be a good area to have my stop at. So I look for those horizontals, I look for those tops, and that's where I would start moving my stop, moving my targets, and keeping in line with my original target based on that chart pattern. So the chart pattern for me, I like to see these in candle glance. I like to be able to recognize the pattern and have the PMO setup. When you get a good PMO setup and you see a good chart pattern, there's a good chance we're going to see that execute. As you're writing it up and you have reevaluation periods, check your indicators. Of course, the PMO for me is my number one go-to. I usually include the OBV because I want to consider volume as well. I don't see the OBV, what it's doing here, because I didn't want to get that involved, but let's move along. So that was a double bottom. Let's see, let's find rectangles are, I think these are really great opportunities. The only issue is they can reverse or they can continue. But I like to look for these because it's very clear what your overhead resistance is. It's very clear what your support levels are. So what's happening as we're trading exactly sideways on this particular pattern with the PMO? Well, let's go annotate. All right. You can see what is happening here. We're going lower and the tops here are sideways. So this is telling me there's a negative divergence. So I wouldn't be looking for this pattern to move to the upside. I mean, you can see the PMO is putting more distance, more distance. This could alert me that this might be a shorting opportunity. It's like a lot of patterns, the length of the pattern becomes your target. So the length of this pattern, let's go ahead and put in. I'll just use the auto support resistance. I'll just do this visually.
Interestingly, it does match up with a couple of pullback
pullbacks here. So I thought that's interesting. All right, so we probably wouldn't have seen, we'd have seen this when we got the breakdown. And I'm going to show you what's going on with the PMO. And we'd be watching, we'd have that negative divergence. And that's when we get the breakdown. And so now our minimum downside target, length of the pattern. So now I have to set my stop and I have to set my target. Well, the target's already here. So where do we set the upside stop? This is actually, in this case, I would say this is subjective. A lot of this is subjective. That's part of the reason I like it, because while it's based on numbers, I still have the opportunity to, be creative in what I'm seeing. So I see a top back here before that pullback. So that would be a possible stop. It's also about halfway through the pattern. So now I have that 2-to-1 risk reward ratio. So let's move it across. What might have happened? And sadly, we're going to pass through. All right, we're looking for those lows. And unfortunately here, we probably would have been stopped out. It happens. But we could continue to watch this pattern because we know that there's issues going on here already. And there's another opportunity to get in, really just the following day. This time around, we didn't quite get to our stop. And we could continue to ride it. We would hit our target down here. And now it's time to reevaluate. I would move my stop just above this original target. I could see levels here. I would tighten it up because I've made my profit on that short sell. All right, let's continue through. Symmetrical triangles. These are typically a continuation pattern, but they can break in either direction. So for me, when I see symmetrical triangles, that is definitely a cue, excuse me, to start looking at the PMO and seeing what's going on. So let's go ahead and move again into the annotate mode. We see the pattern develop. Let's see where we should expect. What should we expect to happen based on the PMO during this period of time? All right, from here to here. So we're going to go. We're seeing declining tops. We're seeing declining tops. So that's a bearish confirmation. If you want to go as far as if we're looking for rising bottoms, really don't see that in here. So we're definitely on the negative. We're below the zero line. I would not expect, looking at this kind of momentum, for a break to the upside. I would be looking for that break to the downside. All right, get to where we can see it. Okay, length of the pattern. There we go. So our downside, if we're going for that with that breakdown, got a big, huge breakdown below that symmetrical triangle, that would be your opportunity. All right. So now where are we going to set our targets? Well, the idea is, of course, it's the length, again, of the back end of the pattern. So that would put us, right, I keep going into those horizontals. Length of the pattern, about here. So this would be our minimum downside target for the pattern. We got the breakdown that clicked on that pattern. So where do I want to set my stop? I would probably set, I can see right here, even in the short term. I'll just pull this back and out of the way. You can see that we've got some lows up here, some intraday lows. I would probably be looking in that area for my stop. I don't want to get stopped out right away. So again, this is very subjective. You can go halfway through the pattern. That's a good way to automatically know you're going to get that 2-to-1 ratio, right? Because half of the length of that pattern and we're looking for the full length of the pattern as our downside target. So that's one way you could consider setting yourself up with just an easy 2-to-1 ratio there. So what would happen? We'd get that move to the downside. In this case, we would fortunately not be stopped out. Let's go ahead and look at here. All right, so we'll travel. Oh, okay, now we hit our target. Time to reevaluate. All right, what's going on with the PMO? We're seeing the spread between it and its signal line getting larger. We can see that it's traveling lower. We've got a lower low already than the previous low. Nothing's looking very good here. So it's time to determine your new target and move on there. So let's go ahead and look at that. All right, I would be going another length of what the pattern would be as my target. We don't have a pattern here. It's time to, like I said, reevaluate. So I would give myself the length of what our previous one was as my target. And there we go, about that 3 clicks here. And what would be the stopping point? Like I said, I don't see anything obvious here. So I would look at, like I said, maybe halfway through, bring it in a little bit if I wanted to, lower my risk somewhat as my possible stop. Again, kind of this is subjective, and a lot of this will be, but like I said, easy rule of thumb, you can just go halfway through the pattern to set your stop and use it that way. So in this case, I think I would set my stop just about here, again, based on the length of space and distance to what my target is. And so we would continue to travel, and we would hit our target here. Now what's going on? All right, I'm seeing some deceleration. I'm seeing the margin thinning. There we go. All right, I could go on, and we could look at all of these various patterns. I would love to go through them, but we only have a short time. I think what I'll probably do is put together a workshop that I will put on YouTube separately, and we can go a full hour and we can really get into this. But the takeaways, let's go ahead and show that summary slide. All right. So the takeaways I would have for you, these were many of the patterns we were looking at. My takeaways for you, again, is you remember all of these, the targets you can set by the length of the pattern. Head and shoulders are a lot easier to figure out those patterns, where your upside and downside targets are. And generally, you're going to have some really good setups as far as setting your stops and your targets. Targets are easy on the head and shoulders. But like I said, if you really need some help, if there's not obvious support or resistance previously in history, you can't go wrong with setting your stop halfway through that pattern. So that way you're setting up that 2-to-1 ratio. So that would be how I would trade my chart patterns. The other thing is, like I said, looking for the best setups. So have fun, go out there and check out these patterns. And I do have a great reference for you. And I'm going to just go back very quickly. Thomas Bulkowski is the man when it comes to chart patterns. And if you go to the pattern site, you will see all of his books and his targets. But this was the interesting thing, and we'll pull up that survey. Which patterns have the best likelihood? High and tight flags. So the flags we were looking at, where you have a very clear one, you don't have this dragging out of a flagpole and a dragging out of a flag. No, it's the high and tights. Those are the most successful patterns. All right, let's go ahead and look at that survey, if we could do that, so we can see where everybody is.
Yeah, great presentation. I would say for me, I'm going to put myself in the triangles. I actually like the triangles the best, which is interesting because that's the one that's the least for everybody in the room, but I love triangles.
Yeah, and I found that head and shoulders, they're not always really good about executing. And so I always am leery of those. But in general, flags are going to be your best bet. But I'm with you. I mean, all of these patterns, they give you such a great hint as to what to do. It just immediately helps you set those stops, helps you mainly set targets. And based on your target, that's where you can adjust your stop. What is your risk reward that you are comfortable with? What is the length of that trade? That also tells you where you might want to set some stops. So.
Yep. And all of these patterns, they do require execution. I mean, just because you see a pattern doesn't mean, for instance, a head and shoulder throughout the bull market. I've seen tons of head and shoulder patterns set up and they don't execute. Market simply goes higher, and the head and shoulder is nothing more than just a neckline support that holds. And then the market, or an individual stock moves higher. So you do want to make sure that these patterns execute. And for me, I'm a volume guy, so I like to see the volume confirm those pattern executions, but I know others don't look as strictly at volume.
Yeah, I do like the PMO, that momentum setups when I start seeing those flags. So I did have a set I was going to show of just some actual patterns that are happening right now. If we have some time, maybe I'll show a few of those at the end of the scooter report. We'll see what happens there. And if not, we can look at those on Thursday.
All right. Sounds good. I want to move on to the 10 and 10.
Yes, let's do that. And of course, I've been talking away. So I'm not going to be able to get all of those more recent ones. Wow. And there are a ton of questions in here. So I'm going to be hanging out in the chat room for sure. Wow. Okay. Let's see. So I'll get in a few of these. Go ahead. Why don't you go ahead and just start with booking, since I have to go and get all of these symbols in here so I can pick. And then all of you in the chat room, please start liking the symbol requests. I'm not taking any new ones, so go ahead and like them. And the most popular will be the next symbol in the 10 and 10.
All right. The first thing I would say about booking, and before I even annotate the chart, I just want to pull up the seasonality just so you're aware. This is one of the craziest seasonality charts out there. And if you look at how booking performs, check out the average monthly returns in the first 4 months of the year, and you can see how often booking. This was the old Priceline.com, by the way. I'm getting used to booking. I could never change from Google to Alphabet, but I'm getting used to booking. But anyway, you can see the first 4 months, the average returns in January through April are staggering. But once you pass through April and you head into May, June, and really the rest of the year, it's like there is no historical bullishness in the last 8 months of the year. And you can see that the percentage of months going higher, it's like a crapshoot, 50-50. So this is one of the weirdest and strongest historical patterns of the year. Priceline or bookings now, I think, is a very solid candidate, especially if the chart starts to get, show strength. I think it's a great candidate, great stock to own in the first 4 months. But beyond that, I'm a little concerned about it because of its historical tendencies. So now let's go back at the chart. And beginning of May is where we say we got to be careful with booking and check out what's been going on since the beginning of May. We've been moving down. We're below the moving averages. There is just something about this stock when we get past April 30th. I just wouldn't own it, especially when it doesn't appear to be particularly strong on a technical basis. Now, so far, it is holding on to this area of support. This was a prior low after the gap up with February quarterly earnings. We pulled back. That was the reaction low. The prior high comes in at about 1975. We're moving back up. My guess is we're going to fail at the 20-day moving average and move back down, but I would really keep a close eye on this support level. I think if booking moves lower and fails to break out here or fails to hold from breaking down at 1975, I'd be careful and most likely be out of the stock.
All right. Let's look at our most popular request. It is IQ. And I'm not sure exactly. IQ, I'm not sure how they say that.
Yeah, I'm going to go with IQYI. I don't know.
I don't know.
Yeah, I'm not even going to try to pronounce it. I don't think that's a word.
Exactly. If somebody wants to put in the chat room how you pronounce it, that'd be interesting.
Yeah, The volume here has really picked up. First of all, I wouldn't trade it because it just doesn't have enough history. I mean, the stock's been trading now for 3 months publicly. I need to see history. I need to go back and look at support levels and what the stock has done previously when it hits certain moving averages. And this one just doesn't give you enough history. So I'm going to pass on it. What I do find maybe interesting enough to pass on here is that now that it went down below the 20-day, it seems to establish a short-term low. But notice it's failing as it moves up here near the 20-day moving average. So I think this is another area that I would watch, at least in the short term. I'm going to keep a fairly narrow range. This has been a volatile stock, but a fairly narrow range between about 30, maybe even bring this down to the intraday lows and highs. Right there's the intraday low at 30, and then the intraday high would be right at about that 34 level, maybe just above. But you can see that 20-day moving average so far as we were above it earlier today, and now we're failing back down below it. I would watch this trading range. If it breaks back down, I think you're probably have broken this uptrend and working your way back down maybe toward the low 20s. If it is able to break out above 34, then I think you got the next candle top near 38 to look at. But again, not a whole lot of data here, so I'm going to pass on IQ.
All right. The next one's sort of interesting. The person suggested, I know I wouldn't do it, but ABWN. And the comment was speculative stock for high-risk investors.
Ugh.
I know, right? But I thought, why not? Let's take a peek.
Yeah, this is like the sharpest falling knife in the drawer. This isn't something for me. I mean, I don't even know where to draw a line, to be honest. I mean, it's just going straight down. So I guess maybe to annotate it for me, it would just be, and you just have to understand this isn't my kind of a deal. I don't like trading these penny stocks. I think they're wildly manipulated on the OTC market, much more so even than small caps on the, in the Russell 2000, with small number of market makers. I mean, this is just crazy. So I'm going to pass. I don't know if you have any comments, Erin, but this is
no. I mean, I know that if you really are looking for this, to me is like a Bitcoin. I mean, I would want to see, you can see all that basing that was happening earlier. We're not seeing any of that yet. So for me, if I was, I don't do this, I don't play those, but I'd be looking for a basing pattern at least to tell me that it's done with what's going on here. I don't know that is the case looking at that pattern and the volume.
Well, it's also 1/10 of 1 penny. So when you're looking at the volume and you see 600 million, you think, wow, this is really heavily traded. You actually back into it, it's $600,000 is the dollar volume on the stock. $600,000. Compare that.
Wow.
To other companies that trade $100 a share and trade millions of shares. I mean, the dollar volume here is extremely light, very easy to manipulate. I'm just not interested.
Yes, I just would caveat, just be careful with that sort of thing. I know people like to do that, but I know you and I basically can't sit here and say, oh yeah, I would think about that, just because that's not our style, and yes, not liking it. Okay, how about, let's see, ETR, the only utility that was discussed. And actually somebody asked me if there was a flag, a flag that was executing there. I haven't looked at the chart, so I don't know.
Well, you gotta move higher, so you got the potential for a flagpole, and this could become a flag. It could be a little bit of an inverse head and shoulder kind of a thing. There's a lot of things it could develop into. I don't know that it's been trading long enough. I'd like to see the flag, go out several more days, or at least a few more days before executing to the upside. But you do have very heavy volume on the move up. You've got pretty good support down at 76. I think it's in a trading range. For me, being up at this 82 level, if I had been trading it and I bought it at support, I would take the money and run and see whether or not it makes the breakout to the upside. Many of the utility stocks have been benefiting from the 10-year Treasury yield moving lower. If that starts to turn back to the upside, this is a group that could easily go back down to recent lows. So I like taking the money, sitting back on the sidelines and watching for another opportunity to develop. So I would take profits here.
Okay, let's see. The next one is ProShares, Ultra Pro Russell 2000. URTY.
All right. Well, I'm not a big fan of the leveraged ETFs. They do erode over time. They're priced based on using derivatives, kind of like options. The way options lose value over time, just because the price of the stock stays the same doesn't mean that the option value is going to remain the same. In fact, it'll deteriorate over time. I think many times these leveraged ETFs, and I haven't gone back and looked at this one in particular, but many times they do tend to erode over time. So I would be really careful. I don't like trading leveraged ETFs. I could put the IWM in my portfolio and leave it, and that's what I've been doing actually recently. I like small caps, but I would just be careful. And even on the technical basis, I would tend to go to the underlying index, which would be the Russell 2000, to make my calls on whether or not I want to continue owning the URTY or not. But just looking at the chart, because we have it up here, 92.5 to 95 seems like pretty good short-term support here.
All right. I like it on the RRG. We haven't looked at this one in a while. Skechers, SKX.
Yeah, I think Skechers also, along with Nike, there's different times of the year you want to continue. You might want to consider owning Skechers, and I don't recall. I think Nike might be the latter part, second half of the year, and Skechers the first half. And based on here, we did drop back in April, so I'm not real sure, but I do remember doing an analysis of the two, and seasonally they tend to have different movements. And so on this one, big gap down, very heavy volume in April. I think if we get back up to 31.75 to 32, I would be a seller until we see it make the breakout above that level. So I would not assume we're just going to go right through the top the bottom of this gap resistance. There was a lot of volume, a lot of sellers came in there, and I would expect there to be some sellers as we approach 32.
Okay. Let's see. Next one will be CNQ, Canadian Natural Resources. And it also is, I like the RRG with that northeast travel in the short term on a daily RRG.
Yeah, this one actually, I pulled up the weekly just to see what was going on here. I think it's holding up pretty well. And I'm going to annotate the recent highs. We did have a bearish engulfing candle at the top here in May. You can see that we continued moving lower. I think we've been setting up higher highs and higher lows, though. You can see the prior low here. Then we stepped it up to here. So I'm expecting a breakout at some point, but we really haven't done a whole lot this year. I mean, the stock opened at 35 and now it's at 35.96. So it's just mostly sideways with a little bit of an upward slant to it. A breakout would be bullish. I actually like the stock much more as it gets down closer to 30 because it would have some pretty solid support down there.
Okay. How about Arrowhead Pharmaceuticals, a biotech company, ARWR?
Yeah, I kind of remember talking about this one. It may have been based on scooters or something, but beautiful move to the upside. Another breakout yesterday. The volume, though, was a little suspect. It did pick up a little, but we got a negative divergence in play. So what that all means to me is it better hold its breakout level. So 14 to me is very important support. The negative divergence that I was referring to is right here. So here is your higher price, and here is your lower PPO reading. So if you go back down, you fail to hold that breakout at 14, I think the 50-day moving average could come into play. The volume is what I was referring to here on this breakout. It did pick up, but clearly it's fallen back. It seems to be losing some of its momentum. The last thing that I would mention here is I want to pull up the sentiment chart, or excuse me, the seasonality chart, because biotechs love the month of July, and I just want to get a sense of whether or not this one has that same tendency in July that many of the biotechs have. And July, yeah, 5.6% on average, goes up 60% of the time. So as long as it holds its support level I talked about around 14, I'd be okay with it. But if it loses that, be careful with that negative divergence.
Okay. Let's see. BL. And that, let's see, I had that one up just to look at it.
Yeah, we got the
black line.
What's that?
Black line.
Yeah, it's coming down and testing this area of support. We put in a nice piercing candle, but notice it's now testing the 20-day moving average from underneath. So I would have expected on this pullback here to hold that rising 20-day as it hit that, because it had some price support as well, right at about the 20 or just below the 20. Here was your breakout, nice increasing volume to confirm it. PPO looks strong. So when it pulls back, I would expect a 20-day test and back off to the races. Here we went below the 20, we went below price support, went all the way down to the next price support, and now I think it's trapped between about 43 and 45, and the 20-day is sitting at 44.99. So if you're expecting a move back up to 50, first thing you got to do is get a break above 45, and some increasing volume would be nice there.
Okay. Our final one will be Salesforce.com CRM.
All right, let's pull this one up. I'll do this one on my relative chart style. And you can see CRM continuing to perform extremely well, even though software has had a pretty rough last 30 days or so. We're starting to bounce back off that recent low, but you can see for about a week and a half, software really took a hit. CRM took a hit, but has already made it back, and yesterday closed at a new high, even though software is still low. So what that means is that you got CRM, Salesforce.com, a very strong stock within the software space on a relative basis, very strong relative to the S&P, and software still, in my opinion, remains one of the areas that I would be considering in terms of trying to beat the S&P 500. So I think there's a lot of positives here, but overall, just annotating quickly, the key here is you've got a stock that just continues to move higher. That is just investing 101. You've got a stock moving higher. You've got software moving higher. You got a stock relative to its peers moving higher, and then relative to the S&P, while the software group relative to the S&P. We've had a number of folks on here. I know Grayson talked about this a lot when he was on with us, but this is what you want to see on a chart, a stock that's moving up from left to right, on all 5 of these charts. So I'm going to find it difficult to say anything bad about Salesforce. I like it. I think a 20-day test would probably be a best entry. It looks like maybe a little bit of a cup now has formed off of the uptrend. So look for maybe some good support around 135.
All right. That completes 10 and 10. You made it through. Here are the list of symbols that we went over. They will be up in the Market Watchers Live chart list. You can find the link to that at the top of the Market Watchers blog from the blogs tab. All right. We'll be right back with the final market update after this brief message.
Volatility is back and interest rates are rising. With the markets headed into uncharted waters, ChartCon 2018 is here just in time. See how the experts are protecting themselves and watch live from the comfort of your home or office as they reveal the risk management strategies they use to stay profitable in any market. Plus, you'll get complete video recordings to watch on demand for years to come. Join us at ChartCon 2018, streaming live August 10th and 11th.
All right, here we go for our final market update. And today, as we mentioned at the beginning of the program, the market closed early at 1 p.m. So at this point, the market is closed. So let's see what kind of action we got today. I find it really interesting. We started up to the upside earlier in the day for the Dow, the large caps. Everybody was looking fairly good here. And then we pretty much took a dive into the afternoon. So we ended up closing for the Dow 24,174.82, S&P 500 at just above 2713. NASDAQ fell 65 points today. You can see mid caps stayed to the positive side, and Russell 2000 small caps still stayed on the positive side. They still pulled back, but finished in the positive. We can see that Canadian markets mostly unchanged, slightly down 15.77 as far as the point change to the downside. Treasury yields started up for the day, but finished lower. We're now looking at 2.84% just about here on that close. TLT forming quite a flag here, but hit that overhead resistance. Looks like over here from what we saw on Friday, hit that level. It does seem to be that it turned back at that point. But we do have a flag formation in the very short term. UUP, the dollar, big gap down, then consolidated mostly sideways, down 8 cents for UUP, 24.98 to finish the day. Oil up quite a bit, and then it just took a big move to the downside, almost the same amount as the upside move earlier in the day, but managed to recover somewhat, but closing lower by 4 cents. USO at 14.92. GLD, big gap up, continued higher after that, but did have a bit of a pullback, but we're seeing gold now when you're looking at GLD at 118.65. So it was up $1.19 today. The VIX mostly unchanged, I would say, when you consider where we have been for the week. We've got reading currently at just about 16, still elevated, but not, I mean, I wouldn't consider it to be, highly elevated and any reason for concern just yet. We did reach up to 18 previously yesterday's trading. So I think that was a bit more of a move to consider rather than what we're seeing now is we're about, we're 2 points below that. So, all right. And that completes our final market update. I think it's a good time to move right on into our scooter report.
Okay, I'm going to do things a little bit different today on the scooter report. First of all, scooter is the StockCharts Technical Rank, as you can see on the screen. And to get to this page, all you have to do when you come into StockCharts, click on the chart school, and then next to the search button there, you just type in SCTR, and there'll be a number of things come up. I'm pretty sure the first one will be this introduction to the scooter rank. Now, what I want to do, because we talk so much about the scooter, is give you a little bit of information in terms of the calculation and then show you some examples of how the scooter moves based on some of these calculations. The scooter is exclusive to folks at StockCharts. You're not going to find this anywhere else. It was developed by John Murphy. John is one of the folks in technical analysis that I've learned so much from over the years. I respect any and all of his work. And I think that the scooter score is brilliant. I think it enables anyone who knows absolutely nothing about the stock market to quickly zero in on some of the stocks that are outperforming and have been performing among the best of its peers. And so let me tell you, or go through a little bit of this and how John developed it and some of the things that we should be looking for. And then I'll show you on the charts how this works. So first of all, the scooter rank is weighted. It is weighted 60% towards long-term indicators, 30% towards medium-term indicators, 10% towards short-term indicators. That 60% weighting in the long term, half of that comes from how far above or below you are the 200-day moving average. And then the other half of that comes from your 125-day rate of change. And again, I'm going to show you how some of this is determined. I'll at least pull up the charts and explain this a little bit more in just a minute. 30% medium term, half of that comes from the percent above and below the 50-day moving average, exponential moving average, by the way. And the other half, 20-day rate of change. And then finally, the short-term indicators. I'm going to spend very little time on this because, first of all, it only accounts for 10% of the scooter score. So many times it'll just have little meaning or impact on the scooter scores. If you focus on this top one especially, and then also kind of at least understand the medium term, I think you're going to have a pretty good understanding of what goes into the scooter and how these scores are calculated. Once you go through this calculation, and this is important because when we're looking at the scooter on StockCharts, it's broken down by large cap, mid cap, and small cap. And I could show you that. I've shown you that plenty of times as we've gone through, and Erin's done that as well. But you've got the large cap stocks, which are made up of the S&P 500. Your small cap stocks are made up of the Russell 2000. And the mid cap stocks are all the stocks that have significant market caps that don't fit into the other two. So it's not in the Russell 2000, it's not on the S&P 500, but it's still a significant market cap. It goes into the mid cap. So that's how the three are broken down on StockCharts. Now, as we go through the calculations the calculation of each stock is going to go through and look at what the percent above the 200-day EMA is, and whatever that percent is, you multiply it times 30%. You're going to look at the 125-day rate of change, whatever it is, multiply by 30%. And you're going to go through and just do these actual calculations for each of these, and then you're just going to come up with a numeric rank. Now, the example here was in chart school was the scooter. This is a 10-stock example. And so what was done here is just 10 stocks are listed. It's just an example, so don't really read into these numbers. But once the score was calculated for these stocks, you put them in a list, and then notice the rank. This is 10, this is 1, but this one, because it's close to this one, doesn't become a 9.7 or a 9.9. It's 9 because it is the second best in this list. So you can see it's evenly spread. The technical rank is evenly spread between 10 and 1. Now, what the ranking system does is it takes these different baskets of stocks. For instance, the large caps I mentioned are the S&P 500. Takes those 500 stocks, and it's once the scores are calculated for all 500 stocks, they get put into a basket. The top 10 scores of the S&P 500 will become the or the top 50 scores, I'm sorry, the top 50 scores go into the first bucket. The next 50 scores go into the second bucket. Then the next 50 scores go into the third bucket, and so forth. And then those stocks within that bucket are then evenly spread within their own grouping. So for instance, Fast in this case is one of 10 stocks. So Fast is, let's replace Fast with the top 50 stocks in the S&P 500, okay? Those stocks are going to have scooter ranks from 99.9 down to 90. The next 50 are going to have ranks from 89.9 down to 80, and so forth. The last one's going to be 9.9 down to 0.1. I'm going to go in and show you a scooter rank here. This is the large cap, and I want you to notice that on the large cap, the scooter ranks, do you see any ties? There aren't any ties because, again, we're spreading them out evenly from 99.9 down to 90, the top 50. So you're not going to see ties. The mid cap is the same way. Now, if I switch it over to the small cap, you will see some stocks that are tied, but keep in mind we have 2,000 stocks now that we're trying to split up into these different baskets. So that means there's 200 stocks from 99.9 down to 90. So you can't help but overlap a little bit in terms of these rankings. Now, I'm not positive, but I think if we took these out to 2 decimal points, Turtle Beach might be 99.82, and this one might be 99.78, but they both round to 99.8. That's the way you have to look at these scooter ranks, okay? So that's kind of the definition. I don't want to spend a whole lot more time. If you have questions or you really want to get some more in-depth on this, take a look. Here was a chart that breaks down for you the 50 stocks on the large cap S&P 500. This is what I was just explaining. The strongest 10% of scores are going to be 90 to 99.9, and then you just keep going down. Then you got your weakest at the bottom. Here tells a little bit about scooter universes. That's what I was explaining. Large cap components of the S&P 500, small caps components of the Russell 2000, mid cap basically large stocks or stocks with significant market caps that don't fall into either of the other two. You've got scooter ranks for ETFs and then also for some foreign exchanges. Okay, so let's leave it at that. Let me pull up some charts now. First, I'm going to go back to that large cap stocks and take a look at the first 3 on the list. ABMD, TWTR, of course, Twitter, and then Netflix, NFLX. I'm going to try to pull up these 3 and just go through them quickly based on the calculations. Here, ABMD, the top indicator window here is the rate of change for 125 days. If I go back and I show you the calculation, percent above the 200-day EMA and basically the 125-day rate of change. So here is the rate of change, 125 rate of change. Here's the 20-day rate of change. So this is for that medium length calculation. Here are the 2 moving averages, the 50 EMA and the 200 EMA. So what you need to see is check out the scooter on ABMD here back in 2014. It was sitting in the 30s, and it just suddenly goes up to almost 100, up in well into the 90s. Take a look at what happened in the price. The price here all of a sudden shot way up above the 200-day moving average. So that score is going to jump very quickly. And remember, that's 30% of the calculation. If you look here, check out the rate of change over 125 days. All of a sudden, it exploded. This is 30% of the calculation. And as the ABMD continues to move higher throughout this here, you can see that the 125-day rate of change hits 200%. 200% in 125 days. That's 4 months. So you get a stock that goes up 125%, or excuse me, 200% in 4 months. It's going to have a major impact on the scooter rank. And even as it started, the rate of change started coming down in one of the heaviest weightings of the indicator, notice the scooter still stayed up in the 90s. That's because even though we were coming back down in terms of rate of change, 75%, even when it fell back to 75%, that's still 75% over 4 months. That's going to put it in as one of the top stocks. I don't know too many stocks that go up 75% in 4 months. So you look at it and you say, well, it's coming down. That means the scooter should come down. Not necessarily. And you can see the scooter remains pretty strong here. The other thing I've noticed with the scooter is that once you make a big move like this and you start trading very bullishly for a while, the scooter stays above 90. And it doesn't begin to deteriorate until you start to dip below the 50 and approach that 200-day moving average, because those are the calculations that really start to impact a stock, in this case, ABMD. So notice when we had this big gap down in October of 2015, hopefully you can kind of see that. I know it's probably small on your chart, but trust me, we had a pretty big gap down in price. And that was after several months of going sideways. Look at that huge drop in the scooter rank. Now, if we go over here and we take a look at pullbacks, for instance, look at the pullback we just had here on ABMD recently. Pretty sizable 10% decline. The scooter hasn't budged. And the reason, we are still up 109% above where we were 4 months ago on this stock. The price is still way above the 200-day moving average. That's 60% of the scooter rank. That's why these pullbacks, some stocks don't really pull back much from these, and others do. Let me go ahead and move on, and let's take a look at Twitter, because Twitter also now has a very strong technical rank, scooter rank. But I want you to go back first and look at what Twitter's scooter history has done over the past few years. It's gone from 0, it goes up to 100 or close to it, back to 0, back up to 90, back down to 0, back up here over to 90, back to 0. I mean, it's all over the place. Why? Well, primarily because the rate of change, we're not seeing consistency with Twitter. We get a big move up, and then it's followed by a pullback and selling. And then we get a big move up, and you see the scooter jump. You know, here we get a spike in the scooter, but then it doesn't last. See, we climbed right here up above that 50. So it's starting to look better on the medium term, but it's still below the 200-day. So it's still struggling to get back up into the upper end of this ranking. But after Twitter went down for a while and sideways consolidated recently, as it started to make the move, look at the scooter jumping, pulling back, jumping, pulling back. And then on this move, all of a sudden on this gap up, it jumps up near 100. And even when we saw this big decline, the scooter barely budged. Here, when we saw the big decline, the scooter went from 99 down to single digits. But the same type of decline here doesn't have the same impact, because Twitter, in this case, has been going up much longer and much stronger, as you can see from the rate of change, 125 rate of change. So here is a perfect example of a stock that, in my opinion, is beginning to look very much like a Netflix. I'm not saying it's going to be one, but this is a stock that all of a sudden now is the rate of change is very, very strong, and that's why you see it ranked so high on the scooter. Let's take a look at one more, Netflix. And I'll look at this one very quickly. But Netflix has been a great performer. Whoops, that's not what I wanted to do. Let's put it in over here so I can get the same chart. Netflix has been a great performer for a long time. Now here it moved up, and you can see we got the scooter rank over 99 to 99, almost 100, and then you can see, look at the rate of change dropping, and as that rate of change dropped and especially went negative, that's when Netflix had some issues back in 2016. But now it's looking a little bit like Twitter recently, but this was back in 2016, and with just a couple of exceptions, Netflix has remained mostly above 70, with just a couple of pullbacks where we had a little bit of 1-2 month type weakness, and you can see we start getting close to the 200-day. The rate of change begins to weaken, and that's what pulls down that scooter rank. But as soon as you get a price breakout and you start to see the rate of change accelerate to the upside, all of a sudden the scooter rank jumps back up into the 90s. So anyway, I just wanted to show you a few stocks and give you a couple of examples and talk a little bit about the definition and the calculation, because we always talk about the scooter. There's several of us here at StockCharts that has it on our charts. I don't use it religiously, but I know Greg Schnell's always got it on his chart. Erin keeps it on many of her charts, and a lot of the other commentators do the same. It is a very powerful indicator, but it has its strengths. It also has its drawbacks, like any other indicator. And I think the best way to use it is to first understand it. So let's just talk about or pull up a summary of a couple of things we talked about here. First, the definition. The second thing I think that's really important is knowing the market cap and understanding how these are placed in different buckets. They are aligned based on how they perform relative to other stocks with similar market caps. So Netflix is not being compared to a small company on the Russell 2000. It's being compared to other large cap stocks. And then individually, I just gave you a few examples of stocks and how their scooters jump back and forth based on some of the calculations. I would just strongly suggest you go back and read about it in Chart School if you have any questions. I think the scooter's powerful, but I do want to make sure you understand it and use it properly.
Excellent. You're so right. I find it, I'm more of an intermediate term trader, so it does have a skew towards the intermediate term and long term, and it gives you a really great, picture of the relative strength of what's going on. And if, I don't necessarily use it right off the bat to trade, but I find that it's great to be able to look at that and know how it is stacking up relatively to its peers.
Yeah, and I think sometimes when you get a stock that's moving higher and really starting to show some strength, the scooter reacts in kind and moves higher, but you get those pullbacks, and when the stock is first beginning to make a run, a pullback in price can bring that scooter down below 70, even though the stock remains very strong. And when it moves back up above 70, I think that's pretty powerful.
Yes. Excellent. Super show. Here's our upcoming schedule. Hope everybody has a happy 4th of July, especially you, Tom, my co-host. I hope you have a great Independence Day.
Thank you. Same to you and to our producers and everybody at StockCharts, and of course, everyone listening today. I want to thank all of you for being with us today. Please remember to complete that survey as you exit. We'd love to get your feedback. I know Erin would like to hear what you thought of her chart patterns. I'd like to hear what you think of Scooter, in the analysis that we went through today. Hopefully that helped you better understand the Scooter rank. But we do just generally like to get your feedback, what you think of Market Watchers Live, of course. Market Watchers Live airs 5 days a week, Mondays through Fridays, except for tomorrow, we're closed, from noon to 1:30 p.m. Eastern Standard Time. Have a great Tuesday afternoon, everybody. Have a great 4th of July. Be safe, and we'll see you back here on Thursday. Happy trading.
Volatility is back and interest rates are rising. With the markets headed into uncharted waters, ChartCon 2018 is here just in time. See how the experts are protecting themselves and watch live from the comfort of your home or office as they reveal the risk management strategies they use to stay profitable in any market. Plus, you'll get complete video recordings to watch on demand for years to come. Join us at ChartCon 2018, streaming live August 10th and 11th.